Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, August 5th, 2023. Hope you're doing well. Thank you so much for tuning in. I hope this podcast is going to be helpful for you. In this podcast, what we're going to do is we're basically going to take a look at all the trades that I took last week. We're going to talk about when I entered the trade, why I entered the trade, and most importantly, how I am going to manage the trade either to the upside or to the downside. After that, we are going to do a few minutes on trader psychology. Always the most important skill in traders in trading is the skill of being patient, waiting for your charts to set up for the entry that you want. And sounds easy, right? But we have FOMO, we have all sorts of psychological things that want to get us in early, fear of missing out. But the ability to create a plan and then follow that plan, that is patience. That is following your process, and that comes between your two ears in your brain of having the right mindset. So it's always helpful for me to teach trading psychology. I hope it's going to be helpful for you to listen to it. After that, I have gone down through my master watch list, both on the dailies and the weekly time frames, and I have identified some potential trades that I'm looking at for next week to possibly enter. The trades are not going to be where they need to be yet, and I talk about this a lot in this podcast and also in my private lessons about the importance of identifying a level either below you or above you that makes sense on multiple time frames, confluence, combination of indicators lining up, but usually they're not going to be there. Usually you just don't turn on your screen and boom, there's the perfect trade, right? We have to wait, we have to be patient, we have to wait for the correct pitch, just an analogy, Warren Buffett analogy, but waiting for that correct pitch to come across the plate before we take a swing. And the nice thing about the market is we can be as patient as we want to and wait and wait and wait until they get there. So I have gone down through the master watch list, both dailies and weeklies. I have identified some levels next week if and only if those levels are hit. And really, in my opinion, that is the very, very best way to trade. Identify the levels, sit on your hands, wait for the market, the market that you're looking at to get to those levels, and then potentially take the trade. But as with all trading, what you really want to do is you want to look for a level, a major level of support if you're bullish and going long. Wait for a major level of support where you know most likely that buyers are going to be coming in, like the 200-day moving average, the 250, the 300, the 30 RSI level if you're using deep dip buy approaches, which is one of the approaches that I teach. And then entering the trade, position sizing correctly based upon the volatility, placing your end of day stop, placing your emergency stop, placing a trailing stop level above you so that if the price starts going your way and you get to that level, now you're in trailing stop mode, taking partial profits along the way each day if it moves the value of 0.45 ATRs from the previous day's close, and then having rules and processes if you get up into the 65 RSI levels, getting up to the 70 RSI levels. And these are all the things that I try to teach in this podcast. We're limited here because of time. But I hope it's helpful. But I do want to mention to everyone that I do teach private one-on-one lessons in the evening time via Skype. I teach a 15-hour course. I teach you all 5 of the trading approaches that I use. And because it's a 15-hour course, I'm able to teach you all the rules step by step. It's a great course. I'm completely filled up right now. But if you are interested in learning the skill of trading from someone that's done it for over 28 years now, just email me. The email is in the link in the description. All right. So hopefully this is going to be helpful. Hopefully I'm going to be able to point out some good potential trades for next week. And because of the pullback that we've had in the market, thankfully, honestly, now we have some stuff to look at. The last 2 weeks have been a little scarce as far as looking for setups because the market's just been so high, and I needed the market to come back and give us some new potential good setups with good risk to reward ratio. So I do have a handful, more than a handful, of potential trades I'm going to be looking at for next week. And I think some of them look pretty good. So, all right. So I have to run the U.S. legal disclaimer real quick. It's about 40 seconds. And after that, we'll start the podcast and we'll get into all this. All right. But hang tight for about 40 seconds while I run the U.S. legal disclaimer. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Thanks for holding through that with me, and let's get started. All right. Current daily trades at the moment. Zions Bank, Z-I-O-N. I am short Zions Bank all the way back here from, I don't know why that line is there, right there, on the 27th of July. Okay, well, I talk about looking for multiple confluences of setups that happen at the same time. And, oh, that was right. Okay, here we go. I actually did take the trade on the 28th. On the 27th, I saw this happen. We went above the 70 RSI and then below the 70 RSI. That's important because the majority of the time when you reach and reject the 70 RSI, that's pretty much it. In addition to that, we had a V1 entry signal to the downside. A V1 consists of two bars, bar 1, bar 2. Bar 2 has to go above bar 1's high and then close below bar 1's low. So nice confluence. Not only did we reject the 200-day moving average to the upside, we also had a V1 to the downside. Now, I didn't take the trade here, although it would have been completely legitimate to take the trade here. But risk to reward is very important in my trading. My risk now would be a close above the 200-day moving average. Okay, it would be a close above the 200-day moving average. I would like to have the price a little bit closer to that level so it gives me a better risk to reward. Oh, I should mention that you can see the pink line up here. This is my emergency stop. So in all of my trading, I have two stops. I have my end-of-day stop, which is, why did I take the trade? Well, because it rejected the 200-day moving average. So if it closes back above the 200-day moving average, I'm going to just get out of the trade. I also have an emergency stop that's 2 ATRs above my entry price. So the next day, I didn't take it on the day that it triggered. I kind of had a feeling it would rebound up closer to the 200-day moving average, which is exactly what it did. So I position sized, and I'll show you that in a minute. I placed my emergency stop 2 ATRs above. My end-of-day stop is a close above the 200-day moving average. Well, that was a good entry because I shorted here at 30.80. Oh, let me show you the position sizing real quick just so make sure I don't forget that, because honestly in trading, I think position sizing is the most important thing in the world. So, okay, but you see why. It went above 70 RSI, below 70 RSI, V1 entry to the downside. It was a little extended from the 200, so I wanted to wait and see if I could get a higher price, which I did here at 30.80. So when I saw this, I said, okay, that's my trade. Now, how many shares do I short in this situation? Well, the rule that I use is 1% of your total capital. So let's just assume we're using $100,000 in total capital times 1%, which is, of course, $1,000. If you had a $50,000 trading account, it would be $500. If you had a $25,000 trading account, it would be $250. You had a $1 million trading account, it would be $10,000. Make sense? So just hypothetically, we're using a $100,000 trading account times 1% is $1,000. Then I take that and divide that $1,000 by the value of the two ATRs. ATR means average true range. That means twice the average true range. So I take the $1,000 divided by 3.85, and that tells me to short 259.7, so 260 shares right here. Now, my emergency stop is always going to be exactly the value of 3.85, whatever it was on the day that I took the trade, above my entry. So you can see I entered here at 38.80, and then I placed my emergency stop how far? The value of 2 ATRs above. So if 259 or 260 shares moves 3.85, voila, that's $1,000. Now, that'll be $1,000. Now, I always wait till the end of the day before I get out of my trade, right? So here I entered at 38.80. If I get a close above the 200, I'm just going to go ahead and get out of the trade. But I wait for the close of the market. However, the emergency stop is different. If it ever gets there, whether it's 1 minute after the market opens or 1 minute before the market closes, I'm going to get out because I have to know what is my worst case scenario on this trade. And it would be $1,000 based upon the math that I just gave you. Now, this does not happen very often. It only happens about 5% of the time that you will hit my emergency stop. If you've been watching this channel for years, you'll know I certainly do hit emergency stops, but not very often. The majority of the time, 95% of the time, your end of day stop will come in. Okay, why did I take the trade? Well, rejection of the 200, under 70 over 70, the V1 to the downside, right? But my ultimate end of day stop is simply a close above the 200-day moving average. Okay, so I hope that helps. So I got short here 38.80. So I've talked about position sizing, end of day stop, emergency stop. Now let's talk about stuff to the downside, okay? Orange line here, this is my trailing stop level. If I get to the trailing stop level, then if I have a close above a previous bar's close, I will cover half of the shares that I was short. All right, and that happened over here on the 3rd. Now, in addition to that, I mentioned at the beginning of the podcast, if I get partial profits, if the price moves the value of 0.45 ATRs from the previous day's close in the direction that I want, I take off a portion of my shares, 10% of the shares that I have remaining. So, over 70, under 70. Rejection of the 200-day moving average. V1 to the downside. Didn't take it. Waited for a little bit better price, which I got. 38.80. Position size. End of day stops over the 200. Emergency stops 2 ATRs above. Trailing stop is 1.5 ATRs below entry. And then I take partial profits. Well, the next day came down. Moved the value of 0.45 ATRs. I covered 10% of the shares that I had. Locked those in. The market can't take that away from me. And now I have fewer shares, so that helps overall mitigate my risk, right? Next day opened up, moved down again, which is the direction that I want it to move. Took another partial profit off. Again, reducing my position size, locking in profits. Next day, down again. Near the bottom here, I took another partial profit off. All right, so I'm continuing to take partial profits, continuing to lock them in. On that day, which was the 2nd of August, we also got to trailing stop level. So now I go into trailing stop mode, which means if in the future I have a close above a previous bar's close, then I will exit half of all the shares that I have remaining after taking partial profits. So that happened on the 3rd. The next day, it did close above the previous bar's high. I got out at 37.20, and I locked in half of the remaining shares at a 4.21% gain. So pretty good trade, right? Pretty good trade. Now, going forward, what was my end of day stop? Well, it was just a close above the 200-day moving average. We're not there yet, right? We're not there. Monday, if it closes above, I'm just out. But I still may have even if it does that, I still will probably have a profitable trade because of the profits that I took here, the profits that I took here, the profits that I took here, the majority of profits that I took here with my trailing stop level, right? So if it closes above the 200, I'll just be out. However, to the downside, If it continues to move down, I will continue to take partial profits. And so the close was 37.92. The value of the 0.45 ATR is 87. So Monday, before the market opens, I will place into my trading system 3 profit targets. I'll take 37.92 minus 0.87. That will be my first profit target, whatever that number is. Then I'll take my first profit target minus 0.87 again. That will be my second profit to the downside. Then I'll take my second profit to the downside minus 0.87 again. That will be my third. So the key here is having rules regardless of what the market does. I know exactly what the market's going to do. If it moves up and doesn't close below the 200, I'm still in the trade. If it moves down, the value of 0.45 ATRs or 2.45 ATRs or 3.45 ATRs, I will take profits on the downside. So I can't control the market one single bit, either can you. But I know exactly what. If it goes down, I'm going to continue to take profits. If it moves up, I'm going to stay in. If it closes above the 200, I'm going to get out. If it, of course, gets up to my emergency stop, I'm going to immediately get out. All right. So this particular trade on the shares that I have remaining, still up 2.29%. All right. Let's go to LMT. LMT is a long position that I took back here on the 31st of July. Why did I take the trade? Well, the orange line here is the 300-day moving average. That's an important level. That's a level where large financial institutions, serious traders, they will look at that level. And here I had an intraday rejection of the 300, which means that during the day it went below the 300 and then it closed above the 300. So it gives me a very good risk to reward ratio because my end of day stop is simply a close below the 300. So I got long here 445.80. I position size based upon how what I explained to you in the Zion's chart just a little while ago. So position size, my end of day stop. Why did I take the trade? Well, I took the trade because it intraday rejected the 300. So if I have a close below the 300, I'm simply out. And then, of course, I have my emergency stop 2 ATRs below, so I know what my maximum allowed loss is. And then orange line is my trailing stop level, 1.5 ATRs above my entry. So if I get there, then I go into trailing stop mode. Well, excuse me, I have a little bit of a cold today. So I got in at 445.80 with the rejection of the 300. Next day, it went up, and it went up enough for me to take off a partial profit, right? So I took off 10% at profitable levels. That's the key point. All right, so I've reduced my position size. I've actually reduced my overall risk. And then we just moved sideways. Thursday, we kind of came down to try to test. And then Friday, of course, we had the big reversal down. Now, did I get out? Well, take a look. The 300-day moving average is 445.71, and we closed at 445.83. So we did not close below the 300-day moving average, did we? So I'm still in the trade. I got in the trade at 445.80. It's 445.83. So yeah, it's up 3 cents. It's essentially even. But the important part of the profit-taking process that I use here was that right here near the top, I took 10% off. So if it does continue down, or Monday, if it closes below the 300, yeah, I'll get out with a loss, but it's a less of a loss than it would have been if I had not have used my partial profit taking technique. Make sense? All right. Hope that was helpful. And then let's go to KMX. You know, one of the approaches that I have used for years, I've learned it from a man called Kerry Lavorne. He's trading partner of Dr. Alexander Elder. This is one of his favorite setups, and it's one of the setups that I teach in my one-on-one course. And when you see the results from this approach, they are really, really spectacular. If you take a trade like this, if you took the trade 100 times, you would have a winning trade somewhere between 75 and 77% of the time. really great. Of course, they don't always work. There's that 25, 26% of the time that it doesn't work, right? But these do not happen often. But when they do happen, boy, do I love them. And, I was teaching students this week. I was teaching student John on Thursday, and I saw this setting up. And I said, look, these are great setups. They don't happen very often, but we have got one in KMX. And I did get long KMX on Friday because of this. It's called a return to value V1 or V2. And by the way, if you go to my YouTube channel in the lessons playlist, there is a video completely free V1, V2 entries, and that will give you a good sense of how these work. So if you'd like to learn more about these, uh, just look in my YouTube lessons video and you'll see a video, V1, V2 entries. So return to value, what does that mean? Well, it means something was above value and returned to value. Well, the green lines here, this is the 1 ATR channel, the negative 1 ATR channel. Anywhere within the green lines is called the value zone. Any price above the green line, you're above value. And you really don't want to buy above value. I don't. I want to buy in value, sell above value, or buy below value, sell in value, right? So here we are above the value zone. Here we come into the value zone. Here we're above the value zone. Here we come into the value zone. So here we were above the value zone. We came into the value zone. But just because it comes into the value zone doesn't mean I just rush in and buy it. What it means is then I'm looking for the chart to do some additional things. So above the value zone, into the value zone. But then I need at least 2 days of sideways motion before I can take a trade. Well, here we come. Now we go lower. We have 1, 2, 3, 4, 5, 6, 7, 8, 9 days of sideways motion. What does sideways motion mean? It means there's price discovery. It means that the buyers and sellers are pretty well evenly matched and it's moving sideways. But sideways motion will lead to a trend eventually. I promise you it will. We just don't know if the trend's up or the trend is down. So return to value. First of all, we need to be above the value zone. We need to come into the value zone. We need sideways motion. And then we need a trigger to get us into the trade. Well, the trigger happened on Friday. V2, bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low. So this is bar 1's low. Bar 2 went below bar 1's low. And then bar 3 closed above bar 1's close. See the little V that it makes here? Now, I don't have a 200-day moving average or a 30 RSI that I'm keying off of here. So when the return to value, sideways motion, V2 entry price, or V2 entry trigger, so I position size, took the trade, of course, placed my emergency stop 2 ATRs below, but where's my end of day stop on a trade like this? End of day stop is simply a close below the low of the washout bar. In the V2 case, the washout bar is bar 2. Halfway here, you see the pink line? This is my end of day stop. So if it simply closes below halfway of this bar, I will simply get out. That's it. So it's a very good risk to reward ratio. And you might ask, well, why halfway of that bar? Well, that is halfway of the washout bar. This is a significant 50% Fibonacci number. So that is the level that I'm keying off of, not just random level. It's a level for a reason because it's half of this bar and there should be some inherent support there. And if it closes below, I'll just get out. So above value, return to value, sideways motion, V2 entry, position size, end of day stops close below halfway of the washout bar. Of course, I have my emergency stop down here. I have my trailing stop level 1.5 ATRs above. So if it gets there, then I go into trailing stop. And then, of course, I have partial profits. And how do we do that again? I take the closing price, 83.29, add the value of the 0.45 to it, which is 96 cents. So 83.29 plus 96 means that on Monday, if it moves up 96 cents, that will be my profit target. If it moves up another 96 cents, I'll take another profit target off. From there, if it moves up another 96, I will take another profit. I always like to get out and scale out of profitable positions on the way up. Does it make sense? So anyway, I got in at 83.25. It's 83.29. So just did that on Friday. So it's essentially break even at this point. All right, let's get over to the weekly trades. Boy, I have been in some of these trades for ages, it seems like, which is good because if I'm in a trade for a long time, that means it's making money, right? If I'm in a trade that loses money, I'm going to be out very quickly. And that's, excuse me, that's profitable trading right there. Be very patient with your winners. Be very impatient with your losers. And most traders do the opposite. If they're in a winning trade, they want to hurry and take profit because it feels good. And if it's going against them and they're in a losing trade, well, hope springs eternal, and they always think it's going to come back, which a lot of times it does, but sometimes it doesn't. But, take my advice. Be very patient with your winners. Be very impatient with your losers. And these are great winning trades, and that's why I've been in so long. Okay, all the way back here, October 14th, I took IWM on the weekly trades. Why? Well, here's the orange line. This is the 300-week moving average. We went below it on Friday because weekly bars close on Friday. I got long right here, 167.19. I position size. My end of day stop is simply a close below the 300. My emergency stop is 2 ATRs below. My trailing stop level is 1.5 ATRs above. And then, of course, as it moves up, I take partial profits. Well, bought this here at 167.19. Next week, nice big up bar, took some profits. Next week, nice big up bar, took some profits. Next week, no profits, but got to trailing stop level. Next week, more profits, no profits here. And then on this particular bar here, this was our first close below previous bar's low. I got out of half of the remaining shares with a profit of 6.53%. Then we had a down move. No profit targets at all, but it did hold the 300-week moving average. And then we had another huge move up where here to here took profits. Here to here again took profits. Then big down move, which of course I didn't take any profits here, but we did hold the 300-week moving average. So you see how the market is respecting this 300 moving average, at least on a intra-week basis. But here we came down, bounced. Here we went below, but I wait for the end of the week, closed back above. Really no profit targets. This week again, we tested it, closed back above, kept me in the trade. And then of course we had this huge move up where took profits here, took profits here, took profits here, took profits here. So I hope this shows you how this, how the position sizing, taking the partial profits, having a good risk to reward ratio, why it is so important. And the remaining shares that I have on IWM doing very well, up 13.94%. Okay, what else do we have? XLF. XLF, another weekly trade. This time I took this back on the 24th of March with a bounce at the 250-week moving average. IWM I showed you was the 300, but I used the 300, I used the 250, I used the 200. So I took this back on the 24th of March with a bounce at the 250, got long here, 30.71 in the midst of the banking crisis. Look, if I would have listened to the news, I would have never taken this trade. But the truth is in what's going on with the technicals. And that was a nice bounce there. Gave me a decent risk to reward ratio. Got long 30.71. Next week moved up. No profit targets. Next week, nothing. Next week up again. Did take profit targets. And I did get to trailing stop level. Now I'm just looking for a close. Either a close below previous bar's low to get out of half or close back below the 250. Moved around for about a month. Didn't do much. And we went up, and then on this week, 23rd of June, we had our first close below a previous bar's low. So I did take half with a 6.4% profit. And then ever since then, it's just been up and up to the off to the races. Next week, took more profit targets, more profit targets, more profit targets. So now I am waiting for us to get to a 65 RSI level, and if it does, I'll get out of out of all of it with the close below the 5 EMA, and or a rejection of the 70 RSI. So current profits on the remaining shares I have here, up 12.06%. All right, last trade, XLRE, which I did take some action on Friday. This is, I got long XLRE at 36.32 on the 2nd of June with a higher low V2 setup. I love these setups. This is the opposite of a return to value V1, V2, but such a great setup. Essentially, you need a close below the -1 ATR channel. You need to rally into the value zone. You need a pullback with a V1 or a V2 trigger, making this high lower than this high. I got long here, 36.32. I position size, emergency stop 2 ATRs below. My end of week stop closed below the halfway, remember, like on CarMax. So I got long here, 36.62. Next week, it moved up. Did take some profits. Then we came back down. Look how close we got to the halfway, but it held. It held, showing you that that halfway is an important level. This week up here, definitely took some profit targets. Again, nothing the next week. Next week, took some profit targets again. And because we got to our trailing stop level, on Friday was a weekly close below the previous bar's low. So I did take half of the profits off, or half of the position off, with a gain of 1.97%. All right, so just real quick recap, I suppose, on the trades on the daily. On the daily on Zions, remaining shares on the short up 2.29%, LMT just about even, CarMax new trade just about even, IWM on the weekly remaining shares up 13.94%, XLF shares remaining shares up 12.06%, and XLE shares remaining shares up 1.97%. All right. Whew. I feel like I've been talking for about 9 hours. All right, let's talk a little bit about trader psychology before we start looking at potential trades for next week. This is from Julian Komar, great trader. You can follow him over at Julian Komar on Twitter. Nice, concise, to the point, but carries a lot of weight. The consistency you seek is in your mind, not in the markets. It would be nice to have consistency in trading all the time, right? Just this nice gradual upslope of your equity curve. That'd be nice, and you can do it, but you're not looking for consistency in the market. You are looking for consistency in your mind, in yourself. You need to have consistency with how you approach the markets. You need to have consistency with your process. First of all, you need to set up a good process. And how do you do that? Well, experience, reading books, watching videos. If you decide to become a one-on-one student with me, I promise I will teach you everything you need to know as far as having a good trading process that covers every single base so that you know exactly what you're doing at all times. But regardless of where you learn it from, you need to have good trading principles, position sizing, emergency stops, end-of-day stops, profit targets, overhead resistance level. These are the things that I'm talking about, good trading principles, and then applying the approach that you have learned over and over and over and over again, and being consistent. Not one day waking up and going, hey, you know what? I think the market's too high. So I'm going to get short here for no other reason than you think it. Or you think, oh, I think the market's at a bottom, I'm going to get long here. Is it just based upon your opinion, or is it based upon the technicals in the market? And if you stick with the technicals in the market, I promise you over time, you're going to be much more consistent. Think about a casino, blackjack, roulette, baccarat, craps. They have a mathematical edge built into every single game, and they have many people there to make sure that every rule, so that that edge of the house advantage is played perfectly. You can't bet too much. You have to bet a minimum. You have floor people. You have eyes in the sky. You have a whole team of people to make sure that the casino is following their process. Well, unless you have a whole team behind you, then you have to rely upon it yourself, right? But the casinos don't take any chance. They have this group watching that group watching this group. So in trading, unless you have a team behind you, you need to be the person, the referee, the enforcer to make sure that you are consistent with your process. And the more you're consistent with your process, the more over time you're going to make money. All right. So I hope that helps. The consistency you seek is in your mind, not in the markets. All right.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as